Alright, let's dive right into the video and talk about the first point on my list, which is a topic that doesn't get much attention: stocks and shares ISAs and inheritance tax. In other words, is your stocks and shares ISA exempt from inheritance tax? The short answer is that it can be, but it all depends on who your beneficiaries are and what rules your ISA provider has laid down. So here are the HMRC rules as I understand them. First of all, it's worth knowing that money held in ISAs doesn't enjoy any special exemption from inheritance tax, but that doesn't necessarily mean that the tax will apply if you pass on that ISA money after you die. In fact, the most important exemption from inheritance tax is for spouses or civil partners passing well to each other, whether ISAs or not. This transfer doesn't attract inheritance tax, making it the simplest way to shield ISAs from the tax. Here is how this works in practice according to HMRC. If you have a surviving spouse or civil partner, they will receive an additional permitted subscription, or APS for short, which is sometimes referred to as inheritance ISA. In essence, an APS is an ISA allowance. It entitles your spouse or civil partner to receive an amount of money corresponding to the sum held in your ISA tax-free. That money in these additional ISAs can then be added to your partner's ISA, or if they do not have one, can be used to start a new one. Just for clarity, an APS doesn't affect your partner or spouse's annual ISA allowance. It's in addition to it. So if you do pass money to a spouse, they will also be able to maintain its ISA status, enjoying tax-free growth and income for themselves, as long as the money is held within it. And that's on top of anything they want to contribute via their own allowance of £20,000 per year. What you also need to be aware of is that for money passed to beneficiaries other than a spouse, there are also sizable allowances or nil rate bands, which give you a buffer before inheritance tax is payable. This normally comes into play according to the size of your estate and the beneficiary's circumstances. Just a quick explanation here: everything owned by a person who is no longer around us is known as their estate. This may be made up of money, both cash and in a bank or building society account, property, cars, etc. Therefore, stocks and shares ISA and inheritance tax will depend on the size of your estate. The threshold for inheritance tax is £325,000. There is normally no inheritance tax to pay if the value of your estate is below this threshold. However, if the value of your estate is above the threshold and you do not pass on your wealth, including your ISA funds, to your spouse or civil partner, the part of your estate above it might be liable for tax at the rate of 40%. Also, if you have a house that's worth no more than £2 million and leave it to your kids or grandkids, the tax-free threshold for inheritance tax purposes increases to £500,000. Now, bear in mind that this information is relevant at the time of the video, and all these rules that I'll be discussing in this video are subject to change. So you should seek professional help if you need it, because this video does not constitute financial advice. Right, moving on, the next point on my list is that not all stocks and shares ISAs let you invest in stocks and shares, despite the fact that they have labeled themselves as such. In fact, the only thing that some providers let you buy inside their stocks and shares ISAs is one of the very small number of their own proprietary funds. You can't typically pick specific index funds and ETFs or build your own portfolio. And quite often, these funds are very expensive, and even the highest risk option that they offer underperforms the average returns you would get from the stock market in the long term. These providers advertise this as the easy investing option for those less savvy investors. They make it sound as if investing is extremely complicated and encourage people to sign up to them. And sure, some people might prefer this if they're really scared of investing in the stock market and don't want to go through the process of building their own DIY portfolio. But be aware that the returns you will get from these robo-advisors, as they're called, will underperform the average return of the market most of the time. As a side note to this, most stocks and shares ISAs are great because they only let you invest in good things, such as company shares and index funds, despite the fact that they come wrapped in a proprietary fund sometimes. ISAs don't let you gamble your money by trading on the foreign exchange market because money in your account has to be kept in pounds at all times. You also can't buy options, futures, CFDs or anything like that. And this is really good because the vast majority of these products are really not appropriate for the average investor. They are very volatile and hard to understand. Compared to general investing accounts, inside an ISA, you aren't allowed to invest in any of these riskier products. So this restriction is a blessing in disguise. Otherwise, many people will lose a lot of money by trading things that they don't fully understand. Just quickly before we move on to the next point, if you haven't subscribed already and are getting any value from this video, please do hit the subscribe button. It really does help small UK channels like mine. Thank you. The third point on my list is that although we have an ISA limit of £20,000 per year, you can actually invest more than £20,000 if you're being smart about it. It's really not that complicated, but people often see this limit and they don't think outside the box. Now, £20,000 per year is a lot of money, so for most people, you'll never need a bigger allowance. But maybe at some point you end up with a big lump sum that you want to invest. Perhaps you get a big bonus at work, you sell your house and make some good profit, or maybe you even get an unexpected bit of inheritance. Who knows? What you need to remember is that the £20,000 allowance is per person. So if you're a couple, for example, each of you gets that £20,000 allowance, and you can open an ISA each and put that amount into your own accounts. And if £40,000 is still not enough for the two of you, there is a junior ISA account per child which lets you put in £9,000 per year. This eventually converts to become a normal ISA when the child turns 18, and at that point you can do whatever you want with it. Therefore, as a family, you can save plenty of money into ISAs every year if each member of the family has their own account. On this point, it's important to mention that you cannot have a joint ISA. While you can have combined bank accounts with your partner, ISAs cannot be filed under a joint name, making this one of the differences between them and savings accounts. However, some of the platforms through which you can manage your ISAs will allow you to add a family member to the platform so that they can see how you're managing your savings. So maybe that's something that you want to consider. Now, remember that this £20,000 ISA limit is only on deposits. There is no limit at all on how much your ISA can grow. For example, if you have invested £7,000 into a stocks and shares ISA for the year and you earn some miraculous returns that will grow that money to £25,000, technically you still have £13,000 left to invest for the year. The idea is that if you contribute less than £20,000 to your ISA and it grows beyond the allowance within a year, you won't have to pay tax on the difference. All that counts is the amount of money you've paid in. My next point is more of a mistake than a rule, but it's worth mentioning here as it's something that many people get wrong: not picking the right ISA account for their goals. I read a comment on a finance channel the other day that said, "I'm going to open a fixed rate cash ISA and once that matures, roll the money into another one. Should I do that or open a stocks and shares ISA instead?" It seems to me that there is a misunderstanding among ISA users as to what each type of ISA is for, with many people using them for the wrong purpose. The truth is that you need to have the right account for your goals. For instance, investing for the long term in a cash ISA is simply suboptimal. Many people do this because they want to protect their money from tax. But the fact is that most people won't even need their cash in an ISA to be protected from tax, because we have a pretty generous personal savings allowance that lets you earn interest on your savings without paying tax on it. For example, basic rate taxpayers can earn £1,000 in interest per year with no tax, and higher rate taxpayers can earn £500 in interest per year tax-free. However, additional rate taxpayers do not get an allowance. Most people are probably in the 20% tax band, so assuming you find a savings account that pays 5% per year, you would have to save £20,000 before you start paying tax. And given that the rates on cash ISAs are so low, you will need even more money in a cash ISA before that works out more beneficial than the personal savings allowance. Now, the main problem with using your cash ISA allowance is that it will reduce the amount of money that you can put into your other ISAs. For example, let's say you received a £25,000 bonus. You decide to save £10,000 and invest the remaining £15,000. If you were to put all of that £10,000 in a cash ISA, you would then only have £10,000 left in your overall ISA allowance that you could put into your stocks and shares ISA. That would leave you with £5,000 that you may be forced to invest in a general investing account and potentially be taxed. So that's why it would be smart to simply put the £10,000 that you want to save in a savings account and invest the rest in a stocks and shares ISA, completely tax-free. At the same time, many people use their stocks and shares ISA allowance for the purposes of short-term investing, which is a huge mistake. If you're thinking of opening a stocks and shares ISA to put your money away for 2 to 3 years, for example, you will first of all pay unnecessary fees for them, and secondly, you'll be vulnerable to stock market fluctuations. And if you plan to withdraw the money in the next 2 to 3 years after your deposit, you're taking on a huge risk that the stock market will be on the rise when you want to do so. But if it happens to drop when you need the money, you'll be forced to sell your investments at a loss. Therefore, the way to treat the stocks and shares ISA is like a retirement account. And if you do open one, do it for the purposes of uninterrupted long-term investing. That means 10 to 30 years. The next rule you need to be aware of is that there is now greater flexibility to pay into the same type of ISA with different providers. However, as good as this new rule is, it leaves the door open for a lot of mistakes, which can take you over your allowance without thinking about it. So bear with me and I will explain why shortly. This rule makes it much easier to have ISAs of the same type in different places in the same tax year. It could also offer cash ISA savers the chance to go after more competitive rates more easily, or pick and mix easy access and fixed rates. It's worth pointing out that you're still only allowed to invest your total £20,000 tax-free allowance. It's not £20,000 per account. So sure, you can have a stocks and shares ISA with Vanguard and then open another one with Invest Engine, but you still have the limit of £20,000 in total, not per account. So don't get this wrong. Now here is where this could potentially be a problem and can take you over your allowance if you're not being careful. In the past, since you're only allowed to open and pay into one type of ISA per year, it was easier to manage your allowance because you knew that whatever money you put into your account would add up and count towards your total £20,000 allowance. Whereas now that you can open as many ISA accounts of the same type as you like, it can make it slightly more confusing for those who are lucky to max out their annual allowance. So I would say that you just need to be aware of this and find a way to track and monitor your contributions, because the platforms themselves have no way of knowing what money you invest in different places. I know that Vanguard won't let you invest more than £20,000 on their platform, and they will tell you if you do so. But when it comes to the amount you contribute to ISAs with other providers, they can't track that, so be careful. At the same time, you are now allowed partial transfers of ISA funds between providers no matter when you pay the money in. This means that you'll be in charge of how much you want to transfer no matter when you made the subscription. So say you wanted to take £5,000 out of your Vanguard stocks and shares ISA and transfer it to a stocks and shares ISA that you've opened with Invest Engine. You could now do that at any point during the year. And this also applies to transfers between different types of ISAs. For instance, you could transfer £5,000 from your cash ISA to a stocks and shares ISA that you hold with another provider. However, you still won't be able to contribute more than your annual ISA allowance. On this note, it's important to clarify that transferring money to another provider will not affect your annual allowance. Many people often get this wrong. Let's say you want to move your stocks and shares ISA from Invest Engine to Vanguard. You've got £5,000 in Invest Engine that you've built up over the years, and you've just deposited £5,000 in Vanguard, leaving you with £15,000 allowance for the year. Now, once you go through the correct transfer procedure and the transfer is completed, that amount will not count towards the current year's allowance. So your £5,000 from Invest Engine will be added to the existing £5,000 on Vanguard, bringing the total to £10,000 in your account. But you will still have £15,000 in the current year's allowance to use, because you've technically only used £5,000 so far. If you're not sure how this works in practice, just check with your provider what the procedure is. Now, here is where things can get messy, so you need to be really careful about it. Make sure that if you want to transfer your ISA to a new provider, you go through the right process. Otherwise, you'll use up your annual allowance without realizing. So what most people do is they first withdraw the cash and then add it to the new ISA account. However, this is wrong and you will use up your annual allowance for the year. It's really easy to make this mistake as it seems like the most obvious course of action, and this may be less of an issue for those with smaller ISA pots, as they are unlikely to use their allowance in full anyway. But it's a headache for those with larger ISA holdings, because making the wrong move could see you lose the tax-free status on a very large chunk of money, making you liable for unnecessary tax charges. So pay really close attention to this and make sure that if you do want to move to another provider, you follow the right procedures. This typically involves contacting the ISA provider you want to move to and then filling out an ISA transfer form to move your account. If you withdraw the money from your existing ISA first without doing this to then put it into the new account, you will not be able to reinvest that part of your tax-free allowance again. However, make sure that your existing provider lets you make an in-specie transfer, as otherwise this will delay things further and force you to sit with cash on the sidelines. An in-specie transfer means moving your shares or index funds to your new stocks and shares ISA provider. If your provider doesn't let you do that and you want to switch to a new one, you'd have to sell your investments, pay all the fees for selling, move the money across as cash, and then buy those investments again on the new platform and pay even more fees in the process. So if you do that, you might lose a lot of money in fees. Your provider can help walk you through the process, so reach out to them if you're unsure what steps to take. Now, here is the thing. Even though we all understand the importance of investing as much money as we can to grow our investment portfolio, many of us aren't sure if we are on track to have enough money in our accounts when the time comes. So check out this video next to find out how much you should have invested for your age to retire comfortably.